You've seen the AI headlines. Honestly, you've seen so many of them that the numbers don't even mean anything anymore. Every single week it's the same thing. Another 100 billion here, another giant campus there, another record broken. The figures got so huge that your brain just stopped caring. You scroll past one on Instagram, you think, wild. And 3 seconds later, you're watching some guy fold a burrito. But here's the thing, we really shouldn't be scrolling past this one. Because this year alone, big tech is on track to spend over $700 billion building out AI. Let that sink in. That's about 2.5 cents of every single dollar the entire U.S. economy makes. Jensen Huang, the CEO of NVIDIA, calls this the biggest infrastructure build-out in human history. And yet nobody's asking the one question that's staring us right in the face. How are we actually paying for all this? And the answer starts with one number, $1.65 trillion. That's what one study found 5 tech companies owe in obligations that never show up on their balance sheets. Meanwhile, those same 5 companies report around $1.35 trillion of debt that you can see. So stop and think about that. The hidden pile of debt isn't just big, it's bigger than the visible one. Take Meta. Their off-the-books debt is almost triple what they actually report. Now, moving that much money into the shadows, that's not something you cook up overnight. It takes a system with a name, and it's a name Wall Street has spent 20 years trying really hard to forget. So let's rewind. Summer of 2007, right before everything blew up, an economist named Paul McCulley stands up at a big Federal Reserve gathering in Jackson Hole, and he gives a warning. He's terrified about a second banking system growing quietly in the dark. Companies that borrow like banks and lend like banks, but technically aren't banks, so no safety net, no insurance, none of the rules real banks have to follow. McCulley gave it a name, the shadow banking system. Now, if that sounds like confusing finance speak, let me break it down in plain English. Say there's a company, let's call it Acme. Acme wants to borrow a mountain of cash, but they really don't want that debt showing up on their books. So here's their move. Acme creates a second company, a separate little entity. On paper, the two are totally unrelated. Different name, different bank account, and most importantly, different debts. This second company borrows all the money. It buys the stuff Acme needs. Then it just leases that stuff right back to Acme. So the second company holds the debt and owns the assets. And Acme? Acme gets to use everything without a single dollar of debt on its books. It's basically like opening a credit card in your cousin's name. You're the one swiping it. You're the one enjoying everything it buys. But when the bank asks about your debt, you get to say zero. Back in 2007, this whole system was built on piles of mortgages. Today, it's built on data centers. The AI boom is running on the exact same financial machinery that broke the world in 2008. Okay, real quick, before we get to where the money actually starts, think about your time for a second. If you spend 3 hours a day typing, going from 40 words a minute to 70 saves you almost 50 minutes every day. That's over 300 hours a year. But what if you could hit 220 words a minute? That's where today's sponsor comes in, Whisperflow. It's a voice-to-text tool that actually works. You just talk, and it cleans everything up, removes your ums, fixes your mistakes, formats it perfectly, all in about 15 seconds. And it's not just fast, it's crazy accurate. It even gets the tricky stuff right, like stock tickers. Whisperflow turns your talking into clean, polished writing on any app, any device. And it's free to start. You can grab 1 month of Whisperflow Pro with unlimited words free using my link below, promo code CASUAL. Big thanks to Whisperflow for sponsoring today's video. All right, back to the money. Here's the problem. problem. The thing that needs all this cash is the biggest buildout in human history, and no single pot of money on Earth is deep enough to pay for it alone. So big tech started knocking on every door with money behind it. They started with the most obvious one, their own bank accounts. And on the surface, these are the safest borrowers on the planet. The top names in this group barely carry any debt at all compared to what they earn, the lowest of any industry in America. So the plan was simple. Just let the cash machine pay for it. But then the machine started getting eaten alive. For most of the last decade, these companies spent about 40 to 50 cents of every dollar they made reinvesting back into the business. This year, that number jumps to 94 cents. 94! They're running their entire cash engine just to feed the AI beast. So it's not that the vault is funding the build-out anymore. It's that the build-out is draining the vault. And once the cash ran low, they hit the bond markets hard. Harder than we've ever seen. From 2020 to 2024, the 5 biggest players borrowed about $28 billion a year through bonds. In 2025, those same 5 borrowed over $100 billion. 4 times their normal pace. And then 2026 hit. In just the first 5 months of this year, they borrowed another $159 billion. Read that again. In 5 months, they borrowed more than they had in the previous 5 years combined. The tech sector now makes up nearly 18% of all top-rated U.S. corporate debt. It got so out of hand that even the International Monetary Fund is waving a red flag. One senior IMF official, a former Fed guy, put it plainly. What's really worrying, he said, is that these giant tech firms are now piling on debt themselves. And when the U.S. market got stuffed full of tech debt, they went global. Back in February, Alphabet raised around $32 billion across 4 currencies in under 24 hours. That included a 100-year bond that people wanted 10 times over. Overnight, these companies became top borrowers in currencies they had zero presence in a year earlier. One bond manager explained why. Even the U.S. dollar market, the biggest credit market on the entire planet, simply can't absorb what these companies need. And that's where this story stops being normal, because you can only pile so much debt onto your own books. Which brings us right back to those shadow companies. See, the big difference between 2008 and today? This time, the shadow banking system is hiding in plain sight. Everybody's missing it because of where it lives, buried in the footnotes of public filings. And the only people who read footnotes are finance nerds. Well, nerds and me. Open those footnotes and it's crowded down there. I could list names and numbers for an hour and you'd still be lost. So let's just zoom in on one deal. The biggest one ever done. The blueprint everyone else copied. $27 billion. All resting on one shadow company named after a New Orleans fried pastry. It's called Beignet Investor, and it exists for exactly one reason: to own a massive data center campus called Hyperion out in rural Louisiana. And Hyperion? That's a Meta project. Meta announced it. Meta designed it. Meta built it. Meta runs it. Meta is the only tenant it'll ever have. But the $27 billion of debt behind it, that belongs to the pastry. Here's how it works. A private investment firm creates Beignet and puts up 80% of the cash. Meta puts in the other 20% and signs on as the only tenant. Then the pastry goes borrowing. It sells $27 billion in bonds to some of the biggest money managers on Earth. It takes that cash and builds Hyperion. Then Meta moves in and pays rent, and that rent pays the bondholders back, all the way out to 2049. So it's Meta's data center, Meta's machines, Meta's engineers inside. But Meta legally owns just 20% of it. Why 20? Because of one tiny phrase in the accounting rules. At 20%, Meta isn't the primary beneficiary. And if you're not the primary beneficiary, that $27 billion of debt isn't legally yours. Poof. It vanishes from your balance sheet. But here's the sneaky part. Buried on page 106 of Meta's annual report, one sentence says they've guaranteed the building for up to about $28 billion. Basically, if Meta ever walks away and the campus is worth less than a set floor, Meta writes a check for the difference. So to Wall Street, Meta says, we don't own it, not our debt. And to the bondholders, Meta says, don't worry, we've got you covered. Same building, Two totally different stories. And this wasn't a one-off. It became a template. There's already a sequel. Over $12 billion in bonds for Meta's newest data center in Texas. Same structure, different pastry. Across the 5 biggest companies, this off-the-books debt has grown roughly 8 times over since 2022. One estimate puts the total hidden exposure across the industry at around $1.8 trillion. A lawyer who lived through the 2008 fallout watched all this and summed it up in 2 words: déjà vu. So there's your answer. How is the biggest build-out in history getting paid for? First, with cash, until the machines started eating 94 cents of every dollar. Then with bonds, until the biggest market on Earth couldn't take any more. And now in the footnotes, where the hidden debt has quietly grown bigger than everything you can actually see. So where does that leave us? Honestly, I've spent weeks buried in these filings and I have no idea how this ends. But I can tell you what has to go right. Because this isn't really an investment anymore. It's the biggest bet in history. And the bet has 4 legs. 1. The revenue has to multiply. Not grow, multiply. Right now, AI brings in about $110 billion a year against over $700 billion of spending. 2. The returns have to stop shrinking. 3. The borrowing window has to stay open, and there's a $1.5 trillion hole between the plan and the money. And 4. The power grid has to handle all of it. But that's a story for another day. Want me to dig into that horror show? Drop a comment and I will. None of this is a secret, by the way. It's all sitting right there in public filings and reports. Stuff nobody reads except the nerds in Patagonia vests. And that's this whole channel. I do the reading. You get the parts that matter. If that's worth something to you, hit subscribe. Because when you step back and look at everything that has to go right for AI to work, this stops looking like an investment. And it starts looking like a parlay. 4 legs stacked on top of each other. And every single one has to hit for any of it to pay off.